In this very brief video, we're going to be looking at what a balance sheet really is, and some of the objectives discussed include defining a balance sheet, looking at some key elements, the 3 key elements that we will describe, and hopefully in future videos we will look deeper into the elements of a balance sheet and use them in practical examples and highlight them. Instead of looking at the balance sheet as a whole, we would look at the elements in that separate series, as we do with some of our other series available on our website, quantiumresearch.co.uk. So, we'll begin with the definition and the key elements. We'll look at an example in practice where we will use our creativity to try and understand the situation of quite a popular company for traders in the UK. It's a very liquid company as well, but we'll mention that when we get there. And we'll discuss briefly some of the limitations of using balance sheets in your investment analysis. So let's begin. We must define first what a balance sheet is, and that is a statement that reports a company's assets, liabilities, and shareholder equity at a specific point in time. So let's go through those 3 points we made: assets, liabilities, and shareholder equity. So we've got assets, and they can be divided into 2 things. You've got current assets and non-current assets. So examples of current assets include things like cash, receivables, and investment holdings. You probably know what cash is, but if you don't know what a receivable is, imagine you are a business and you have money due to be paid to you over the next 30 days or 60 days or whatever. Then that's classed as a receivable, something that is technically yours, but you haven't got it yet, so it doesn't come up on your balance sheet. So those assets that we've just mentioned, anything that can be liquidated easily, so anything that can be sold within under a year, is classed as a current asset. But if we look at non-current assets on this side, these are ones that have a longer life. So things like property, plant, or all sorts of things, equipment, things that will have a value 1, 2 years down the line, 3 years down the line, above a year's length. So remember, the differentiation between a current asset and a non-current asset is that a current asset can be liquidated easily, so in under a year, and non-current assets take a bit of time and they have a longer life above a year. So they could be a 30-year bond or something like that. That is classed as a non-current asset. But the current assets are the bits of cash or the immediate investment holdings. Say if you want to sell some shares, they count as current assets, assuming they're liquid, of course. So let's look at liabilities now. We can divide these into, similarly as we did before with assets, we can have current liabilities and non-current liabilities. So it really is quite simple. Current liabilities, short-term debt. So if you, instead of receivables before, if you have payables where you have to pay something in, say, 30, 60 days time or whatever as a business, then that's classed as a current liability. But what if you have longer debts, things that are maturing in a year and beyond? Then that would be classed as a non-current liability. So something like a mortgage for a human would be a non-current liability or long-term debt. And current liabilities, short-term debt, less than a year. Remember, it's the difference between current, if you got it in front, that's a year. Non-current, it's beyond a year. And now let's dive quickly into the equity section of a balance sheet. Remember, there's 3 bits: assets, liabilities, and equity. You don't even need to say shareholders' equity really, because it's mostly seen as equity. But the way to calculate equity is simply taking this asset section and taking the liability section. You take the liabilities, the total amount of liabilities, so current liabilities plus non-current liabilities, you take that away from the total asset figure, which is calculated by adding up the current assets with the non-current assets. So we'll have an example of a real-life balance sheet here. This is for British American Tobacco, quite a well-known business to traders in the UK, and it is one that has been around for quite a long time. But hey, let's look here quickly. We have the first kind of half of the balance sheet to fit on the page, and we should go through what these columns mean. On this side that I'm kind of highlighting, we have our most recent half-yearly balance sheet statement. You can see this bit ending on the 30th of June 2019, and it's in millions of pounds. So each one digit is representative of millions. So the first one here is £7 million, and 8 is for 80 million, and so on. We've got this column that is the half year of the same period in the previous year. So instead of the 30th of June 2019, this half year balance sheet statement bit says it is responsible for the, say, 6 months up until the 30th of June 2018. So this is basically the half year of the previous year we've highlighted. And the previous half year's data for the balance sheet is here. Just remember this whilst we're going through some stats, and that will help. But we've also highlighted some of the terms we discussed earlier. Assets, non-current assets. Well, assets are divided into non-current assets and current assets. We have total figures as well shown accordingly. And we have a couple of annotations that we could probably go through quickly. You can see that remember this is the most recent half-yearly report for the balance sheet for British American Tobacco, ticker symbol LSE, BATS, BATS. We can see that they've improved in terms of their size of total non-current assets. Not by much versus the previous half year, by what? A couple million here and there, not so much, but a couple million obviously does sound like a lot, but with respect to what, 133 odd billion pounds size of non-current assets for their total, it doesn't seem like much, but against the same period in the previous year, they've made an improvement as well. So that's a good sign you normally see. And if we look deeper into their total current assets bit, we can see that they've made an improvement on the previous half year from here, 148 billion to 146, well, from 146 odd billion. So they're up roughly 2 billion, let's say. And the same period in the previous year is up by roughly 5.5 billion, which is quite nice. So looking at some of the figures here, one key point we could probably shine some light on is their cash figure. They had about 2.6 billion pounds in the previous half year, and in the most recent half year they have 3.3 billion pounds. And if we look at the same period but the previous year, that half year bit of data, they've also improved from then. So from there to there to there, they've consistently improved, roughly 500 million additional cash, and then up by about 700 million. That's probably because the business has been much more profitable, and hence they've been generating more cash. But it could also be as a result of borrowings, which we'll see in the next section, and we could probably maybe see if that is the case, and if it's not, then maybe they have been quite profitable. You'd have to look at things like income statements and cash flow statements to try and understand this in a little bit more detail, but we're just trying to initially create some ideas first by looking at the balance sheet. As you'll probably recognize from earlier, we mentioned the three parts of a balance sheet. So you've got equity, which is, remember, the total assets minus the total liabilities. And we've got our liability section here that is divided into non-current liabilities, basically liabilities that are due in over a year. And we've got current liabilities, those liabilities, bits you owe that are due in less than a year. So income tax payable, that bit is within the year. Borrowings are essentially classed as short-term debt here. And there are some other sections, or subsections rather, in these relevant larger sections, these categories. And we will hopefully go through them in a separate series on our site. But in the meantime, it's just important to remember these main areas, the equity bit and what liabilities are divided into, and before we had with assets, what they're divided into, non-current assets and current assets, and so on. Let's probably pull up an example on this second half of the balance sheet. We've got an interesting bit here. Borrowings have decreased in terms of long-term borrowings under the non-current liabilities section. We put an arrow upwards here to show a positive change, because in the previous half year, the 31st of December 2018, the total long-term borrowings figure was at 43 billion and 284 million pounds. And now it is at 41 billion 581 million pounds. So that's what, 1.5 odd billion pounds less debt. Assume that they've been, as we mentioned before, cash is up, debt is down. That's a good sign. Normally you'd think debt would be up. But if we look at the current liability section, short-term debt, the short-term debt is much higher. In the previous half year, it's 4.225 billion pounds, and now it is 8.711 billion pounds. So that's what, a 4 billion increase. You have the long-term borrowings down by 1.7 billion, and you have the cash up by roughly 700 million pounds. So really, this short-term debt that has been taken on is worrying because it outperforms, or rather, it is much larger than the improvement in long-term debt and the improvement in that cash position. So what we should probably think here is, why have they borrowed that much? Is that to fund further growth? Will it fund existing, or will it fund projects that will create a lot of profits for the firm? We don't know, but by looking at the balance sheet, we can bring up some maybe red flags or positive scenarios and then dive a little bit deeper. But with balance sheets, it's important to know that there are limitations. And we should ask ourselves what these are, because if you're looking to analyze a company's balance sheet, you should keep in touch with the reality of things. And one example there is that when the balance sheet is released, say for the 6 months ended the 30th of June 2020, let's just say, at that point, you won't be getting that on the exact day. Sometimes you get these balance sheets released 3 months later, which means you have a 3-month gap, which is worrying. You wouldn't be able to know what is exactly going on at the time you're looking at the company's statements. So there's not a real life audit going on every minute, but rather you have a delay, which means you may think that there's nothing wrong with the business, but there could be something horribly wrong going on under your nose, which is extremely worrying to consider. And there's also the issue of subjective valuations. People, or auditors rather, those that value these assets, how can they put a fair value on something that is intangible, something that you can't feel, so like a brand value? How can you value it so correctly? And even if there is a fair, accepted by most experts method, right, then there will be some form of margin of error, maybe 5%, 10%, either way, which reminds us that there is a subjective valuation taking place. It's kind of like exam papers, but not as vague, but hopefully you'll get the drift that I'm trying to put out there. And we should also remember that the figures that are given out may not be reliable. You have scandals going on where companies can easily manipulate their figures by bribing officials, maybe not specifically in regulated markets, but in less regulated markets, it is possible. We need to be totally careful as investors and dive deeper into figures and try and understand how they have been justified before we can be comfortable with investing in something. So hopefully we'll create a separate mini-series where we'll go deeper into balance sheets, some things like amortization and depreciation, of which many investors aren't familiar with. If you're interested in learning more about those elements within a balance sheet, the deeper terms that are used, then head on over to our website, quantiumresearch.co.uk. You can see the web address there, or if you're already on there, feel free to look around our video section, our video library, and we will have some videos going into that for you.